There is a line inside the Internal Revenue Service code that decides whether $900,000 is a comfortable retirement or a slow financial bleed, and it has almost nothing to do with the $900,000. It has to do with a single number, 59.5. If you stop working at 57 with $900,000 saved, and the majority of that money sits inside a traditional 401k or a traditional individual retirement account, every dollar you pull out before you turn 59.5 is hit with ordinary income tax plus a 10% early distribution penalty on top. Not a fee, not a spread, a straight 10% removal enforced by statute, in addition to whatever bracket you land in. Which means the person who retires at 57 with $900,000 and the person who retires at 60 with $900,000 are not holding the same amount of money. They are holding two different numbers, and nobody at the Human Resources Orientation ever drew that on the board. Here is the number nobody put on the chart. A 57-year-old pulling $40,000 a year out of a traditional 401k to cover living expenses in the 22% federal bracket pays roughly $8,800 in federal income tax and another $4,000 in early withdrawal penalty. That is $12,800 gone to cover $40,000 of spending. To actually put $40,000 in your pocket, you have to withdraw closer to $58,000. 3 years of that pattern, from 57 to 59.5, and you have removed something in the neighborhood of $174,000 from an account you spent 30 years building to fund $120,000 of actual life. $54,000 evaporated into tax and penalty. And the money that left never compounds again. I'm Pierce. 25 years as an accountant, corporate tax, small business books, individual returns, audit prep. 25 years of sitting on the inside of other people's financial lives, watching the same 3 or 4 structural mistakes repeat across completely different income levels, completely different professions, completely different personalities. And the question I get more than almost any other, especially from people in their 50s, is some version of, do I have enough? Is $900,000 enough to walk away before 60? Everyone wants a yes or a no. The honest answer is that the number by itself tells you almost nothing. What tells you something is where that number lives, when you can touch it without penalty, and what percentage of it the tax code has silently reserved for itself. Let me anchor you in reality first, because I think most people asking this question have no idea where they actually stand relative to the country. According to the Federal Reserve's Survey of Consumer Finances, the median retirement savings for American households aged 55 to 64 is $185,000. For households aged 65 to 74, it is $200,000. Those are medians, the true middle of the distribution, not the average, which gets dragged upward by a small number of very large balances. More than half of American households report no dedicated retirement savings whatsoever. And of the households that do have retirement accounts, roughly 9.3% have $500,000 or more. If you are sitting on $900,000, you are not behind. You are in a small minority of American savers, and you got there by doing the boring thing correctly for a very long time. Your behavior is correct. The system is not. But being in the top slice of savers does not answer the question, because the question is not, am I doing well? The question is, will this last? And the mechanism that determines the answer is one that the retirement industry consistently underexplains, because explaining it fully would require telling people that the account they were told to maximize is the wrong account to retire early on. Let me walk you through the machinery step by step, the way it actually operates. A traditional 401k and a traditional individual retirement account are tax-deferred vehicles. You put money in before tax, it grows without annual taxation on dividends or capital gains, and you pay ordinary income tax on every dollar that comes out, not capital gains rates, which are generally lower. Ordinary income rates, the same rate as a paycheck. Layered on top of that is the early distribution rule. Withdraw before age 59.5, and the Internal Revenue Service adds a 10% additional tax. There are exceptions, and I'll get to the important ones. But the default rule is the one most people are living under. Now stack the second mechanism on top, health insurance. If you retire at 57, you are 8 years away from Medicare eligibility at 65. 8 years of buying coverage on the open market. For a couple in their late 50s, an unsubsidized marketplace plan can run somewhere between $15,000 and $25,000 a year in premiums, depending on the state and the plan tier, before deductibles. That is not a rounding error against a $900,000 balance. That is potentially $200,000 of spending over 8 years for the privilege of not being uninsured. And here is where the two mechanisms collide in a way that almost nobody models in advance. The Affordable Care Act provides premium tax credits based on your modified adjusted gross income. The lower your reported income, the larger the subsidy. But every dollar you withdraw from a traditional 401k counts as income. So the early retiree pulling money from a traditional account to pay for health insurance is simultaneously raising the income figure that determines how much that health insurance costs. You withdraw more to cover premiums, your income rises, your subsidy shrinks, your premiums rise, you withdraw more. It is a loop that tightens on itself, and it operates most aggressively on the exact person who did the responsible thing and put everything into the pre-tax bucket. Picture a very tall building with an express elevator. Your savings are on the top floor. You spent 30 years riding up, floor by floor, adding to the pile every payday. Now you want to come down. The building has two ways out. There is a wide, well-lit staircase with a landing on every floor, and there is a single express elevator that only starts running at a specific hour of the day. Before that hour, the elevator is locked. If you need to get down before it opens, you can, but there is an attendant at the door who takes a piece of everything you carry out, not a small piece. And here is the part that undoes people. Most of them spent 3 decades stacking everything they own on the top floor without ever asking what time the elevator starts running, or whether there was a second staircase they should have been building alongside it. The building was designed with an exit. It was just designed with an exit for someone leaving at a different hour than you plan to leave. The hour is 59.5, and the second staircase is the part almost nobody builds. Let me prove this with numbers, because I don't want you taking my word for the shape of it. Take 2 people, both 56 years old, both have $900,000, both plan to stop working at 57, and both need $50,000 a year to live on. I'll assume a 7% average annual return throughout, and I want to be explicit about why. The long-run historical return of the broad United States stock market has commonly been cited in the range of 7 to 10% before inflation. I am using the bottom of that range deliberately. 7% is conservative. It is not a promise. It is not guaranteed. And actual results in any given decade vary enormously. The point of using the low end is that if the math works at 7, it works. David has all $900,000 in a traditional 401k. That is the default outcome for someone who did exactly what the enrollment brochure told them to do for 30 years. To net $50,000 of spendable cash before 59.5, David has to withdraw roughly $72,000 because he owes federal income tax on the whole amount, plus the 10% penalty on the whole amount. Over the 2.5 years between 57 and 59.5, that is approximately $180,000, leaving the account to fund $125,000 of living. $55,000 burned, and every one of those dollars was going to keep compounding at 7% for the next 25 years. $55,000 compounding at 7% for 25 years is approximately $298,000 of terminal wealth. That is what the first 2.5 years of an early retirement cost. David, not $55,000. Roughly $300,000 of what his money would have become. Patricia is the same age with the same $900,000, but hers is split. $600,000 in the traditional 401k, $150,000 in a Roth individual retirement account she has held for more than 5 years, and $150,000 in an ordinary taxable brokerage account. Patricia funds those first 2.5 years almost entirely from the brokerage account. She sells shares, pays long-term capital gains rates on only the gain portion, not the whole withdrawal. And at her income level, a meaningful chunk of that gain may fall in the 0% long-term capital gains bracket. No penalty, no ordinary income treatment on the principal she already paid tax on years ago. Her reported income stays low, which also protects her Affordable Care Act premium credit. She withdraws roughly $52,000 a year to net $50,000. Her 3-year cost of bridging to $59.5 is about $6,000 instead of $55,000. Same age, same $900,000, same spending. The only variable that changed is which container the money was sitting in. And the gap between them, projected forward at 7%, is roughly $250,000 of retirement wealth. People over 50 face this in silence. They face it in silence because the question feels embarrassing to ask out loud. You have $900,000. You are supposed to feel secure, and admitting you are not sure whether it works feels like ingratitude. So the calculation never happens, and the first real answer arrives in the form of a tax return that is thousands of dollars higher than expected. Now here is where I need to take apart the diagnosis, because I have heard the wrong one in my office hundreds of times, and it is the single most expensive misunderstanding in this entire category. When someone sits across from me at 56 with $900,000 and asks whether they can stop working, and I show them the arithmetic, the first thing almost every one of them says is some version of, "I should have saved more. I got a late start. I should have been more aggressive in my 30s. They reach immediately for a personal failure explanation, because that is what 3 decades of financial media condition them to reach for. The entire genre is built on the assumption that any shortfall is a shortfall of effort. That is the wrong diagnosis, and believing it produces exactly the wrong response. The real problem is not what you think it is. The problem is not that you saved too little. In most of the cases that walk into my office, the problem is that 100% of what you saved went into a single tax container, and that container was engineered around an assumption about your life that turned out to be false. The assumption that you would work until 65 or later, that you would never need the money before 59.5, and that your income in retirement would be lower than your income while working. Those 3 assumptions are baked into the structure of the traditional 401k. If any of them turn out not to describe your actual life, the account works against you at exactly the moment you need it most. This is not a discipline problem. It is a math problem. Discipline got you to $900,000. Discipline is the reason you are in the top 10% of American savers. Discipline is not the constraint. Container allocation is the constraint. And container allocation is a structural decision that was made for you by default on your first day of employment by a plan design that had no idea when you intended to stop working. Which brings me to the part of this I find hardest to state calmly. The financial services industry knew this and said nothing, not in the sense of a conspiracy. There is no room where people decide to withhold this. It is quieter and more ordinary than that. Employer plan enrollment materials are written to drive participation in the plan, because participation rates are what plan administrators are measured on. Every incentive in the system points toward getting the contribution percentage up and toward keeping assets inside the plan. Nothing in that incentive structure rewards anyone for telling a 40-year-old that if they might want to stop working at 57, they should be building a taxable brokerage account and a Roth alongside the pre-tax plan. That conversation reduces contributions to the plan. It reduces assets under management. It complicates a message that works better when it is simple. And the simple message, max out your 401k, is not wrong. It is incomplete in a way that specifically damages the people who succeed at it most. While I'm on the subject of what the industry underemphasizes, let me put a number on the table that anyone watching can verify themselves. The SPIVA Scorecard, published by S&P Dow Jones Indices, measures actively managed funds against their benchmarks. Over the 15-year period ending December of 2024, not a single United States equity fund category, 0 out of 22, had a majority of active managers outperforming their benchmarks. 0 categories. Over the 20-year period from 2005 through 2024, 94.1% of all domestic funds underperformed the S&P 1500 Composite Index. Fewer than half of those funds even survived the full 20 years. The rest were merged or quietly liquidated, which removes their track records from the databases used to market the survivors. I read prospectuses. That is the job. The expense ratio disclosure in most fund documents is technically accurate and practically unreadable, and that is not an accident of style. On a $900,000 portfolio, the difference between a fund charging 1% and a broad index fund charging 3 basis points, 0.03%, is roughly $8,700 in the first year alone. Compounded over 20 years at 7% gross, that fee difference is worth several $100,000 of terminal wealth. Same market, same holdings in many cases, different line in a document nobody reads. Let me tell you about the client I mentioned at the top of this, because his story is the reason I structure this conversation the way I do. I'll call him David, not his real name. 58 years old when he first came to see me, a manufacturing operations manager, 31 years with the same company. He had done everything by the book, full employer match captured every year, contribution rate raised with every promotion, never cashed out during a job change, never touched it during 2 recessions, never panic sold in 2008 or in 2020. $940,000, and every single dollar of it was in the traditional 401k. He came to me because the company had offered an early retirement package and he had 90 days to decide. He was tired, his knees were bad, he wanted out. He had already run his own numbers, $940,000, a 4% withdrawal, $37,600 a year, plus his wife's part-time income, plus Social Security at 67. He thought it worked. What he had not modeled was the bridge. 7 years from 58 to 65 with no employer health coverage, and 18 months of that stretch before he turned 59 and a half, during which every dollar out of that account carried the 10% additional tax. He had not modeled that his health insurance subsidy would shrink in direct proportion to how much he withdrew to pay for health insurance. He had not modeled that with no taxable account and no Roth. He had exactly one source of cash, and it was the most expensive one to touch. We built the actual projection together. 7% assumed return, conservative against the historical long-run range, real premium quotes from his state's marketplace, actual bracket math. The version of his plan he walked in with, retire at 58, draw exclusively from the traditional account, ran the balance down to under $300,000 by age 73, at which point required minimum distributions would begin on the remainder. The version where he worked 19 more months to clear 59 and a half converted a portion of the account to Roth during the low-income years afterward, and built a small taxable bridge from the severance package instead of putting all of it into the plan, ended near $700,000 at 73. Roughly $400,000 of difference. From sequencing, from containers, not from saving more, not from a better fund, not from market timing. He did not say anything for a while, long enough that I stopped filling the silence and just let it sit there. And when he did talk, what he said was that in 31 years, not one person, not the plan administrator, not the human resources presenter at open enrollment, not the advisor who called once a year to review his allocation, had ever mentioned the words 59 and a half to him in the context of when he might actually want to leave. 31 years of doing it right, and the one variable that determined whether it worked was never on the sheet. He was not ruined. He is fine. That is what made it hard to watch. He cried because he had earned better information than he got. The window between when something is visible to those paying attention and when it becomes obvious to everyone is where generational wealth is built or lost. In David's case, that window was about 10 years wide, somewhere in his late 40s, when redirecting even a fraction of his contributions into a Roth 401k or a taxable account would have cost him almost nothing and changed the entire shape of his 50s. So let me give you what he did not have. 3 concrete moves with numbers that anyone with an ordinary American income can execute. Nothing here requires capital outside the reach of a normal worker. First move, build the bridge and size it exactly. Take the number of years between your target stop work date and the year you turn 59 and a half. Multiply that by your annual spending need. That product is your bridge requirement. If you want to leave at 57 and you spend $50,000 a year, your bridge is 2.5 years times 50,000, $125,000. And it needs to live somewhere that is not a traditional pre-tax account. A taxable brokerage account is the cleanest option. Roth contributions, the amount you put in, not the earnings, can generally be withdrawn at any age without tax or penalty, which makes an established Roth individual retirement account a legitimate second layer of that bridge. For 2026, the individual retirement account contribution limit is $7,500, or $8,600 if you are 50 or older. Second move, audit what your money costs and fix it in one sitting. Pull every statement. Find the expense ratio on every fund you hold. It is in the prospectus, in the Fund Details tab of your brokerage account, or searchable by ticker on any fund research site. Write each one down. Anything above 0.25% deserves a direct comparison to the lowest cost broad index option inside the same plan. The Vanguard Total Stock Market Index Fund charges roughly 3 basis points, which is about $30 a year on a $100,000 position. Compare that to what you are paying now. This takes about 20 minutes, and the most common error is switching your future contributions to the cheaper fund while leaving the existing balance parked in the expensive one. Move both. Third move, use the gap deliberately. For those of you over 50, and this is the group where the leverage is highest, the years between when your paycheck stops and when required minimum distributions begin at 73 are the lowest tax years you will ever have again. In 2026, the 401k employee contribution limit is $24,500, $32,500 if you are 50 or older, and $35,750 for those aged 60 to 63 under the super catch-up provision. But the more important number in that window is what you convert, not what you contribute. Converting portions of the traditional balance to Roth while your taxable income is temporarily low moves money permanently out of the ordinary income column. Model it with a licensed professional before executing. The interactions with premium credits and Medicare thresholds are precise and unforgiving. There is one more provision worth knowing, because it is the escape hatch written directly into the statute, and almost nobody hears about it until it is too late to use well. Internal Revenue Code Section 72, subsection T, allows what the Internal Revenue Service calls substantially equal periodic payments. You will also see it called a 72T. It permits you to take distributions from a traditional individual retirement account before 59 and a half without the 10% additional tax, provided you follow a rigid schedule. You calculate an annual amount using one of 3 approved methods, and you take exactly that amount every year for 5 years, or until you reach 59 and a half, whichever is longer. You still owe ordinary income tax. You just skip the penalty. The catch is the rigidity. Change the amount, miss a payment, or take an extra distribution outside the schedule, and the Internal Revenue Service can retroactively apply the 10% penalty to every distribution you have taken under the plan, plus interest. It is a genuine tool, and it is the right answer for some people. It is also a commitment you cannot informally renegotiate when your roof needs replacing. Do not set one up without a licensed professional running the calculation and the interaction with the rest of your income. Now let me close David's loop and let me put the cost of waiting in dollars, because this is the part that changes behavior. David worked 19 more months. Not because I told him to, because once he saw the 2 projections side by side, the 19 months stopped feeling like a sentence and started feeling like a purchase. He cleared 59 and a half. He took the severance and, instead of pushing all of it into the plan, put a meaningful portion into a plain taxable brokerage account holding a broad low-cost index fund. He retired at 59 and 8 months with a bridge built, and he began measured Roth conversions in his first 2 low-income years, staying below the thresholds that would have raised his Medicare premiums 2 years later. He is 63 now. His balance is higher than the day he stopped working, which surprises people every time I say it, and it should not. A portfolio drawing at a sustainable rate while compounding at a reasonable return can hold its level for a long time. The difference between the plan he arrived with and the plan he executed, projected to age 73 at a conservative 7%, is in the neighborhood of $400,000. That is the number that changes everything. Not because $400,000 is a fortune, because it is the difference between a retirement that has slack in it and one that has none. Here is the cost of another year of not looking at this, stated as plainly as I can. Say you are 54 with $900,000 and it is all pre-tax. Suppose that if you ran the numbers today, you would redirect $18,000 a year of new contributions toward a Roth 401k and a taxable bridge account instead of the traditional side. Waiting 1 year to make that change does two things at once. It costs you 1 year of $18,000 sitting in a container you can access without penalty, which at 7% over the 10 years to age 64 becomes roughly $35,400 of penalty-free, tax-advantaged money you now do not have. And it costs you 1 year of the low bracket conversion window, which does not roll over. Those years are finite, and they close permanently at 73 when required minimum distributions begin. Over a full decade of delay, the compounding runs the other way on you. 10 years of $18,000 redirected annually at 7% is approximately $249,000. That is not extra money you had to earn. It is the same money, routed into a container that does not charge you a 10% toll to leave early or force distributions on the government schedule. Certainty never arrives before the price does. You will not get a signal telling you the window is closing. The window closes on a birthday. And let me name one more thing directly, because I watch people make this mistake in the opposite direction. When someone finally understands the 59.5 problem, the instinct is often to swing hard toward cash. Pull everything into a savings account so it is accessible. Safety that does not beat inflation is not safety. It is slow wealth destruction. The Bureau of Labor Statistics measures consumer price inflation, and over most of the last several years, it has run meaningfully above what a standard bank savings account pays. Money parked at a fraction of the inflation rate for a decade loses purchasing power quietly and continuously. Accessibility and growth are two different problems, and solving one by destroying the other is not a solution. So here is the framework. I call it the exit plan, and it is 3 components you can complete this week. E is for 18 months. Take the date you intend to stop working and count the months to your 59.5 birthday. Write that number down. If it is a positive number, you have a bridge to build and its size is fixed. That month count divided by 12, multiplied by your real annual spending. Not your budget, your actual spending, pulled from 12 months of bank and card statements. Most people are off by 15 to 20% when they guess. This step takes about 30 minutes, and it produces the single most important number in your plan. X is for cross-check the containers. On one sheet of paper, list every account and what tax bucket it sits in. Traditional pre-tax, Roth, or taxable. Add up the 3 columns and write the percentage each represents of your total. If the pre-tax column is above 80% of everything you own, and you intend to stop working before 59.5, you have a structural problem, and it is fixable with time. The target most early exit plans work toward is having the bridge requirement from step E fully covered by the Roth and taxable columns combined. 10 minutes with your statements gets you the whole picture. I and T together are for income throttle. This is the ongoing one. Every year between the day your paycheck stops and the day required minimum distributions begin, you are choosing your own taxable income. You decide how much comes out of the pre-tax account and how much comes from the taxable side. Set a target income figure each January before you touch anything and manage withdrawals and conversions to land under it. That single figure controls your bracket, your Affordable Care Act premium credit if you are under 65, and, once you are on Medicare, your premium tier 2 years later. One number, set once a year, that governs 3 separate costs. And here is the mistake that voids the whole thing, which comes straight back to the invisible villain I started with. The plan built for a life you did not end up living. The mistake is building the bridge and then leaving it in cash for the entire time. Someone runs the exit plan, calculates that they need $125,000 of accessible money, moves it into a savings account, and lets it sit there for 8 years while they wait to reach 59.5. They solved the access problem and created a new one. 8 years of $125,000 earning materially less than inflation is real purchasing power gone. The bridge is not one bucket. The money you need in the next 12 months belongs somewhere stable. The money you will not touch for 6 or 7 years belongs invested in something broad and low cost, because it still has a long runway. Treating the entire bridge as short-term money is the most common way people convert a good plan into an expensive one. If you are going to run the exit plan on your own accounts this week, meaning you are actually pulling statements, counting the months to 59.5, and writing down your 3 container percentages, comment exit below. I want to see who is doing the arithmetic and not just nodding along. And if this was useful, subscribe. It genuinely helps the channel keep producing this kind of analysis rather than the surface-level version that is everywhere already. Next week, I'm going to take the next layer of this same problem. What happens inside the account in the 5 years immediately after you stop working? Why the order in which your returns arrive during that specific stretch matters more than the average return itself, and how to structure withdrawals so that a bad first year does not permanently reduce what the rest of your retirement can be. Everything in this video is educational and reflects publicly available data from the Internal Revenue Service, the Federal Reserve Survey of Consumer Finances, S&P Dow Jones Indices, and the Bureau of Labor Statistics. It is not personalized financial advice. Every financial situation is different. Your income, your state, your health, your spouse, your timeline, your existing balances all interact in ways a general video cannot capture. Before making investment, tax, or retirement decisions, consult a licensed professional who can review the specifics of your individual circumstances.